Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Excellent.
And I'm going to share my screen. While I'm doing that, if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube, and Will's watching it. He'll read it back to me. And to give you guys a couple minutes to put those questions in, what we'll do is start out taking a look at the pre-market report. These are stocks trading in pre-market hours. We'll see if we could get some insights, and then we'll move on to the questions. All righty. So pre-market report. Again, these are stocks trading in pre-market hours. We have this calendar view, which does allow you to go back to a historical date if you're interested to see what happened in a pre-market hours historically. Today, we're on January 5th. This is what's going on so far from a high level. We have 270 stocks that are trading higher in a pre-market, 550 stocks trading lower. As far as volume goes, we have 90 million shares trading on up volume and 156 million shares trading on down volume. And if we convert that volume to dollar value, we have $745 million worth of stocks trading higher versus $4.2 billion worth of stock trading lower. So from a high level, it seems that the trading in pre-market is trading with a bearish sentiment or bearish lean. Okay. Let's look at it from a couple more perspectives, dive a little bit deeper, and see if we could things look different. So we're going to move down the page, and now we see a list of different stock symbols that are trading in the pre-market. Okay. We have a list of our most active stocks, our biggest percentage gainers, and biggest percentage decliners. We have 43 stocks that made our biggest percentage gainers list, 126 stocks that made our biggest percentage decliners list. Now, to make this particular list, the stocks do have to meet certain thresholds that we placed, because things in the pre-market can be very illiquid. Sometimes you only have one share that traded in pre-market. So we do set liquidity thresholds, price, volume, and so forth to make this list. And if we look closer in the list, we do see that there could be small cap stocks in there, ETFs, leverage products. It could be a preferred closed-end fund. So any security listed on a major U.S. exchange, if it's trading in pre-market hours and meets our thresholds, it can make this particular list. And to narrow it down to a small group of stocks, we could use the filters above here. If you created a watch list and you just want to filter by your watch list, you could use this filter here. I'm going to use this filter in ETF as our example. And when you click on it, you get a drop-down menu to select from. Here, you can choose different ETF symbols. We're going to use this one, SPY, and click on it. The list below gets filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. So the ones that made our biggest percentage gainers list, and there's only one, meaning that the price move, volume, the way it's trading, was enough to make our biggest percentage gainers list. It trades outside its normal pre-market range. And then we got 10 that made our biggest percentage decliners list. So, and again, these are stocks that are trading outside their normal percentage change in the pre-market and with enough volume to make this list. So that also kind of points to a bearish sentiment or bearish bias in the pre-market trading. We gave it a couple minutes, Will. I think at this point, I'll take some questions if you have some.
Yeah, no questions have popped up yet.
Okay. Let's default to then SPY. Let me come down to the options chain here. So sometimes one of the we get questions. Sometimes, they're emailed. Sometimes we get other questions that people make comments or questions on videos on YouTube that we put out. So I'll just default to some that I could just kind of, pull out of a hat from memory. And let me go to an options chain, a couple days away. And, one of the questions is, well, how does hedging delta work? And if you look at the Black-Scholes model, the Black-Scholes model produces certain Greeks. These are statistics, and those Greeks are there to help you manage risk. Okay, it's there to help manage your options risk, your portfolio risk. And when we talk about managing risk, I think some people get confused with it, because sometimes I'll get a question, well, how do I manage a loss? But that's not managing risk. There's no such thing as managing a loss. Managing risk is mitigating your risk ahead of time to avoid unnecessary risk. Okay, that's what you're trying to avoid some risk or avoid a potential loss that you don't want. Okay, so what's an example of managing your risk, avoiding risk? Well, if you have a house, right? Let's say you bought a house. Well, if you want to avoid, a catastrophic loss due to a fire or a flood, then to manage that kind of risk, because there's a potential for it, right? There's some kind of potential that, hey, if my house burns down, I'm going to lose 90% of what I paid for it. So you buy insurance, right? Well, that's one way to manage a catastrophic or tail risk. You want to avoid that unnecessary loss, and there's usually a cost to it, right? So sometimes hedging and mitigating risk, there's a cost, right? It's not free, actually. It's never really free. Another way that you may mitigate risk or avoid risk is say, well, if I bought a property and I want to rent it out, right? Well, because I have a carry cost and my carry cost is high, so I'm going to rent it out, and I'm going to use that rent to help pay for the carry costs, the taxes, the insurance, and so forth. Well, if you could rent it out, let's say in Airbnb, right? And then you could rent it out, daily or weekly. But let's say you want to avoid that risk fluctuation of like there could be periods where you're not making any income, or it's uncertain if you're going to rent it out in the future. So maybe you rent it out and you have a 1 year contract, maybe 2 year contract, and every month what rent you'll receive, right? Well, then you're just avoiding that fluctuation, volatility risk of from month to month, and now I have like a steady income. And so all these stuff, right, that you're doing, it's trying to mitigate or avoid or manage your risk ahead of time before something happens, right? You're managing it to prevent some kind of losses, and there are costs to it. And that's what we talk about when we say manage risk of your portfolio. Why risk? Because you're trading risk assets, right? All these are when you're managing, you're buying and selling options. Those are risk assets. You're managing the inventory of those risk assets. So let's take a look at how can I mitigate directional risk, right? Let's say I want to buy an option because I think the implied volatility is very low. Okay, so let's just take a call here in SPY. So I'm going to go into SPY. I'm going to look at an options chain, and here I have a call option, $2.33, $2.35, and I see the implied vol of this option. It's 10.6. Well, let's assume that I think that for this demonstration and argument's sake, I think the implied volatility of that option is just too low. Okay, so I think maybe that it should be 12. Okay, so whatever the market is, the order flow in the market forced it down, the premiums down to a level where I think like, well, this option, looks to me like the premium assigned to it is too low, or that implied volatility is too low. Like maybe I'm looking at, I think it should be 14.5. Let's assume, because that's the 52-week average. Well, all right, well, if I think it's too low and it's too cheap, I don't want to sell it. But if I think it's going to revert to 14.5, then I would be on the buy side, right? So let's just do that. So I'm going to click on this, and then now you see that, sorry. So now we see that this option is 235, right? So buy January 10th, call 468 at 235. And by the way, if I want to see, well, what would it be worth if implied volatility is 14, right? Potentially, what would I think this option should be priced at if implied vol is at 14? What kind of a discount here am I getting? Well, so let me close that first. Let's first do that. So that means I need to run a theoretical value. So here's a theoretical value. This is just putting the Theo's best fit line. But if I wanted to see potentially, well, if implied vol is 14, right, then if it was at 14 right now, so where would this option be priced, right? What kind of discount then am I getting here? Let's say like I'm trying to figure that part out. Because if it's 1 penny, or it might not be worth it, right? It's like, well, 14 vols, it makes it worth 236. Well, that's not really a big discount, because my commissions will be higher than that. So then the question will be, well, what kind of a discount am I getting if I think implied vol is 14? It's at 10 now. So So we need to run that through the theoretical model, right? I need to figure out at 14 vol, what is this option worth over here versus where the markets are. I know where the markets are. That I could observe 233, 235. But in theory, if I think that the markets have overdone it to the sell side, and this is going back to 14, let's run. Look, so I'm going to run all these 14, right? I'm going to run a model. I'm going to give an implied vol of 14, and then we're going to look at what this theoretical value would be. So let's do that first. So I'm going to come up here, and I'm going to change the theoretical value column. Okay, from best fit, I'm going to open this up, and I'm going to say run me the black shoals, but I'm going to put a custom vol in. I'm going to put a custom implied volatility. I'm going to change this to 14. Okay, and I'm just making up 14 just because, you know, I looked at this and I'm like, okay, in the last 20 days, the stock moved at the last 52 weeks. Sorry. If we looked at the last 52 weeks of data, right, and we looked at how did the stock move on a 20-day vol basis, you know, it's been 14. So that's the average. So I'm going to put that in there. All right. And once I put 14, I'm going to hit OK. And all these theos are going to get recalculated for me. Right. So now I'm looking at every single option with a theoretical value given a 14 vol using the, you know, binomial. All right. So here we go. So we were looking at this 468 call. And we said, okay, right now the market is 233, 235. And that's given a 10.6 vol. If I ran a 14 vol, then in theory, this option at this moment would be worth $3.15. So if 14 is correct, you know, if that's the correct vol, because we don't know what volatility will be in the next 6 days, and we don't know, you know, what today, you know, the options could get pushed either way. I mean, 14 might be, you know, I don't know, that's 40% increase. That might be high, but let's just assume for this argument's sake, we feel with strong conviction it should be 14. Well, then in theory, this option in the market would be priced around $3.15. Right? So what's that, like an 80 cents? Whoa, am I right? 80 cent discount or 80 cents away.
Yep.
So that's pretty significant, right? That would be a pretty significant discount. You know, when we're talking about a $3 option, you know, $3.15 option, 235, that might be a significant amount discount to say, well, if I feel that strongly, then, you know, in theory, there's a lot of edge there. There's a lot of cushion there. If I feel like if it should be anywhere close to 14, right? We could even give it 13, 12 and test those theories. So, you know, that will be one of the benefits of using like something like a you know, option pricing model or binomial, because now we could create a valuation and see where's the market at versus where do I think, you know, this option could be worth if I give my own assumption, right, about volatility. So let's say we ran through this exercise and said, okay, yeah, that looks interesting to me. You know, that option does look interesting to me from the buy side. So let's go back to the original best fit line, which is basically just taking the markets and trying to run a best fit line through the implied vols. So we're back to our original market, and now let's say, okay, I'm going to buy this at 235, right? So here it is. Buy 10 468 calls for $2.35. I'm going to run this. And here, you know, I get a payout diagram. So this is what it looks like, you know. So if the stock goes up, that looks great. I have a directional risk. If stock goes down, it doesn't look great. So these are my other risks, right? Because now I have a directional risk. It's not just volatility. Because if the stock drops, then what does it matter? That I bought this call, because even if implied vol like ticks up, but the stock goes way down, it's going to be a loser, right? And I have all these now. This is the model. It gives me all these metrics to help me manage my risk, right? These are all these metrics, like that. Hey, like think of it as you're driving a car, right? You're driving a car, but you have all these things in there to help you manage. It tells you how much gas you have left, because if you don't have enough gas, you're gonna run out of gas. The car is gonna stop, right? If you need an oil change, or it gives you the speed you're going at. If you're going too fast or going too slow, you have all these levers to help you get to your destination, right? These are the things that are helping us. If what if our objective to say is that just we think the premium is too low, right? We don't know the direction. We just think the premium is too low. So how do we manage that risk to try to just get the exposure to the implied volatility, the premium, but we want to mitigate, or we want to, avoid some of the losses due to direction, right? So that's when hedging comes in. Hedging comes in. There's a cost. Remember, there's always a cost to hedging. There's always something you're giving up to take off risk, right? It's not free. There's no such thing as, oh, just yeah, I don't want this risk. Just take it off, and I'm not paying for it. I don't want to lose money if my house burns down, but I'm not paying for the insurance. So, but I want the insurance anyway. There's no such thing like that, right? So you got to think. There's always a cost to taking off some risk. So let's just say that, we did 10 of these contracts, just to make it a little bit, let's say instead of 1, we did 10. So here, I'm going to increase this ratio, and I'm going to rerun it. So now I have 10 of these. And now this is saying that my delta is 479. Let's say 480. Well, what does that mean? Well, what this means is, based on the Black-Scholes model, right? If I bought 10 of these contracts and the implied vol stayed the same, there's no time decay, nothing with Vega or interest rates. If everything else I kept as a constant, right? And I'm just looking at the directional risk. What kind of directional risk do I have if everything else it stays the same, is a constant? Well, this is saying that if the stock moves up $1, we make $480 on the position. That means the Black-Scholes model is saying not at expiration. Keeping this, it's not at expiration. This is saying right now, right? If this happens before expiration, my media risk is that if it goes up, I'm long 10 calls. The position will make $480, and if it goes down $1, I lose $480, right? So if it goes one way, that's great for me. That's what I want. But if it goes the other way, goes down, then it's a loser. But keep in mind, our original thought process, right, for looking at this option was not directional, right? We don't know. It wasn't where we felt strong. We didn't feel strongly about one way or the other, right? We didn't feel like I feel strongly it's going to go up or it's going to go down. I just think the premium itself is low, okay? That was our original analysis. So we may not care. We may not even want this risk of up or down. We don't care. Yeah, we're willing to forego $480, of profit if it goes up, to take off the loss if it goes down. Right? That's what we want. We want to be neutral, up or down. We want to break even, with the assumption that the implied vol and the premiums will go up. So that means we need to take off the risk of losing $480 on a dollar move, right? So how do we take that off? Well, if we want, that means we have to make $480 on the way down, $1. How do you do that? Well, you sell 480 shares of the stock, right? So the hedge would be selling 480 shares. What will that mean? Well, my options will lose $480 with $1 move, right? But I will make it back up in this stock, right? So one side of it is going to lose. The other side is going to make up for it. That's the hedge, right? So my options are going to lose $480. My stock, on the other hand, should make $480. So the two of those offset. Remember, because that's directional risk, right? So the directional risk, they offset. My hope is, though, that if the implied vol goes up, my options will actually not lose $480. They'll lose less, because remember, if implied vol goes up, this assumes implied vol stays the same. But if implied vol goes up, then my options shouldn't lose 480. They should lose maybe 200, and then the stock will make up for it. Okay, so that's on the downside. But what about the upside? Well, on the upside, if the stock moves up $1, well, I just shorted 480 shares of stock. That means I lost $480 on that trade, on my hedge. My hedge lost $480. But on the flip side, I own these options. I own these 10 options. And if these 10, and if this is correct, my options should increase in value, right? That it'll be $480 profitable. So those two offset. Again, this whole time, you're managing that directional risk with the hope that the implied vol goes higher, right? And if the implied vol goes higher, what will happen? Well, if the stock goes up and you lose 480, the options go up, they make 480, but if implied vol ticks up, the option should make more, right? Because 480 assumes implied vol stays the same. But if implied vol goes up, the options will be worth even more. Of course, your risk is that implied vol goes down, that you'll lose. Okay. So what you're trying to do here is manage and mitigate your directional risk, your delta, to isolate your exposure to the implied volatility. Okay. And now, what about after the stock moves up $1? Well, now you'll have a new delta, and you'll have to rehedge that new delta at that point, right? So this is your initial hedge. All right, well, we're right up at 9:30. Hopefully that answers some questions we had out there outstanding.
Yeah, that was great, D. I didn't want to interrupt you, but Rob was asking, and it was, there's a delay, so I don't know in what process. He asks, is that what the trading cards do automatically, create values and likelihoods of outcome based on historical performance and data? Obviously, we're at the opening now, so I'll copy that down. Maybe we can talk about it on Monday. Also, remember, everyone register for the IBKR webinar. That will be on Tuesday at 2. You have to do that on their site. Awesome job, Dima. You have a great weekend, buddy.
Everyone, thanks for joining. Stay safe out there. Have a great trading day, and have a great weekend. And hope to see you guys on Monday.
Have an awesome weekend and a great trading day, everyone. Bye.